Welcome back to our quarterly investment update. Hi, Mash.
Hi.
Last quarter, you were chatting with Chris to talk about, it had just been Liberation Day. We'd just seen quite a shock in the markets. And I think Chris really wanted to talk to our clients about how we're reacting to that as a business. Only 3 months has passed, but we've actually seen quite a lot of activity over those 3 months. So there's been a number of different announcements about tariffs. We've seen unfortunate events in the Middle East. What's been going on with markets over the last quarter?
Yeah, so it's been a really bumpy start to the second quarter of the year. And obviously, when I met with Chris, we were talking about the impact that Liberation Day, as it was coined, had on the markets. And then, after that, we have actually seen things calm down quite a lot. We've seen the real tensions that we saw between the US and China, that's calmed right down. We saw a 90-day pause placed on the tariffs, which has just come to an end. And actually that brought a lot of sort of respite to the tensions that we saw within markets. So a lot of things have sort of peaked and then come right back down. We've also seen geopolitical tensions really rise. We saw Israel, place an attack on Iran, which further escalated the conflicts that was already going on in the region. We saw the US start to get involved there as well. So generally, the sort of events going around the globe have been quite hectic, but the actual impact to markets and particularly in portfolios has been quite well contained. Clients who have had a well diversified portfolio haven't actually seen that much happen, and generally markets saw a real bumpy start, but actually have since settled down, and most of them have finished positive for the quarter. So obviously a lot of stuff going on. How have our clients actually reacted and how have they felt over the past quarter?
Yeah, I think as Chris was saying at the last update, really, our advice is always to hold your nerve, hold tight. We had a lot of conversations with clients, generally driven by us to make sure that they're feeling okay, part of our service. But really, I think we've seen this quite a lot. It's not like going back sort of 20, 30 years ago where you'd have a market correction and then everything would be fine for sort of 5, 10 years. It's quite a regular occurrence. You see a dip in the market and then things come back quickly. I mean, the FTSE passed 9,000 this week, record high. But so our clients are generally quite well trained now. I think they like to have the conversation with us, but they're that seeing what's going on around the world, it's not pleasant. But as far as their investments are concerned, I think they're much more comfortable with holding tight because they have ridden those cycles many times before. So with what's been going on over the last quarter, how have our portfolios been reacting and performing over that time?
Yeah, so obviously, when the quarter started, there was a lot of volatility. Markets and our portfolios as well had a difficult start to the quarter, definitely. However, it really came through. Having a well diversified portfolio made a real big difference to clients, and so making sure that you weren't too overexposed to those more volatile parts of the market really helped. And since things have calmed down, actually clients have been able to enjoy that more positive journey throughout the end of the quarter. So actually the second quarter has ended up positive for the portfolios, which has been great news for us as well. And sort of that main focus on diversification and actually active management very much remains a key focus for us, because we think whilst that volatility period might have finished, that uncertainty very much still remains. We don't really know what's going to happen. The conflicts out in the Middle East are still there and could escalate. Well, the impact it has might be minimal for now, but we don't know at the end of the day. And then also what we're waiting to see is how that translates into macro data. We're seeing inflation figures, global GDP figures moving around quite a lot, and the impact that can have on portfolios. We're still waiting to see what happens there for some time.
Okay. So you've talked there a bit about sort of global GDP, global inflation. Thinking about what's going on at home, our clients would be seeing in the news, they'd be reading in the news, some disappointing figures, I think you could say, for recent GDP, recent inflation. So what's going on really in the UK at the moment?
Yeah, so in the UK, I think the first point to touch on is there's definitely a difference between the economy and the markets. So you touched on already, actually, FTSE's already recently hit an all-time high. But the sort of macro data, like GDP figures, we've seen 2 months now of surprisingly negative growth. And actually, that's what we need to be able to manage. So, we've been talking about inflation and the risks that poses to the global economy for a while now, and we're just trying to make sure that we don't enter into too much of a low growth environment. So what we're waiting to see really is for growth to steady up, and that at that point we can maybe start to see those rates start to come down as well. We're seeing that sort of low growth being targeted, definitely. I think we're seeing, recently at Mansion House, we saw the Chancellor really try to encourage investors to not get stuck in a low rate environment, and really encouraging them to go and invest their capital. And that will, as long as people do it, will make a big impact on being able to keep trying to stimulate growth in markets and the economy as well. So, I mean, the impact UK has on a global portfolio is actually quite minimal. So I think, again, it's trying to separate the two, the effect it has on us as UK residents and consumers, and the impact it has on investors. The two are quite different, so I think, yes, it's not great to see that negative growth we've seen in the UK, but actually the impact it has in the portfolios has been, quite small.
Okay. So sort of record growth in markets at the moment, but interest rates not coming down as quickly as we wanted them to, or how they were predicting that they were going to at the beginning of the year. So actually in people's pockets, they're not feeling that things are improving, but actually, as you say, you've got to separate out the two. So how about globally then?
Yeah, so globally, that's where the impact on portfolios is much more of a thing, particularly the US. The US, what happens with their inflation and their growth will have a much larger impact on portfolios. So it's something we're keeping a closer eye on. We've seen Donald Trump criticize the Fed on not cutting their rates fast enough, but the Federal Reserve really want to show that they are independent, that they aren't effectively being run by the president, but also they really need to make sure that they don't cut their rates too early. So they're just trying to manage their own sort of policies to ensure that they can time their cutting of rates perfectly. The US inflation is just slightly above that 2% target at the moment, but they just want to make sure that, they're timing it right effectively. We've seen some data in the US come out that haven't been in line with expectations. Their jobs data actually was better than expected, which, you know, pushed that inflation figure up a little bit. So they just need to continue keeping an eye on it, really. Unlike so in Europe, we saw their sort of inflation figures start to dip below a little bit, so they had to sort of take their foot off the gas somewhat just to try and bring that back up, because otherwise, you risk entering into a really low growth environment, which again starts bringing recessionary pressures, etc. So that's the main focus is keeping an eye on those policies, making sure that we don't cut rates too quickly, but equally that we aren't holding off too much, that we enter into a low growth environment. So definitely a key focus in our portfolios at the moment.
Okay. Thank you, Mash. So really, in conclusion there, the markets have finished positively. They are already really pricing in a certain amount of uncertainty. So we're not, the volatility hasn't been quite as extreme as some might have thought. We're still confident that interest rates are heading in the right direction, but just a little bit slower than was originally expected. But that's because we're just trying to be sensible. We're trying to keep inflation in check. And we want to make sure that, inflation doesn't go out of control again. So just sort of hold tight and wait and see, really. And diversification, as always, is key in these situations.
Yeah, absolutely. Diversification, having a well diversified global portfolio, and we believe having high quality active management is definitely what's going to be what makes the difference for client portfolios and the general journey that people experience over the next sort of 12 to 18 months. And like you touched on, I think clients and markets themselves are much better in tune with managing uncertainty at the moment. So yeah, it's just keeping an eye on things as they develop.
Great. Thank you very much, Mash. And thanks for joining us.